Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at BlackSky.
If you find our talks useful, please consider subscribe, like, and comment underneath. So let's just get right into unpacking this, because I want you to imagine a scenario here.
Okay, let's hear it.
You are looking at a company's year-end financial report, right? And they tell you their revenue only grew a pretty measly 4% last year.
Yeah, 4% is, that's rough.
Exactly. Usually if you see 4% top-line growth in like a tech or a space play, you just throw that chart right in the trash. You don't even look twice.
Oh, absolutely. You'd assume the growth story is totally dead.
Right. But then you look at the actual stock price. Yeah. Because back in November of 2025, this stock was sitting at a 52-week low of $6.15.
Down in the dumps, yeah.
Totally washed out. But fast forward to mid-April 2026, and it has just violently exploded to a new high of $36.90.
It is honestly an absolute jaw-dropper of a move. I mean, you are talking about a 400% plus run in just a matter of months.
Right, over 400%.
Yeah, and when you see that kind of massive, post-collapse recovery, it just forces you to stop and pay attention to what the market is trying to price in.
And I think that brings us to the core wealth-building question for you listening today. Because when you see a 400% run practically overnight, you really have to ask, is Wall Street just hallucinating?
Right. Like, is it just a hype cycle?
Exactly. Are we looking at some temporary sector squeeze that is going to, leave retail traders holding the bag? Yeah. Or did the smart money just spot a fundamental structural transition into a sustainable high-margin mode?
Because if it is a real turnaround, well, that completely changes how you build an investment thesis around this.
It changes everything.
Mm-hmm.
So, to get to the bottom of that, we have to look past the stock chart, right? We have to dig into the underlying mechanisms of their financials.
Right, because price action of this magnitude, it's usually the market front-running a fundamental inflection point.
Okay, so let's look at that top-line momentum we mentioned earlier, the 4%.
Yeah, so for the full year 2025, revenue grew that modest 4% to $106.6 million, which on the surface is totally underwhelming.
Very underwhelming.
But the real story is the acceleration hiding inside those numbers. Because by the time we hit Q4, revenue had actually accelerated to $35.2 million.
Oh, wow. Okay.
Yeah, which is a 16% year-over-year increase for the quarter.
Okay, well, 16% is definitely better than 4%, but it still doesn't exactly scream like, 400% stock price increase,
No, it doesn't.
So what is actually driving that specific acceleration? Like, what's under the hood there?
So the wealth-building signal here is the segment mix shift. It's not just how much money they're making, it is how they're actually making it.
Okay, break that down for me.
Well, their Mission Solutions segment saw its revenue surge by an incredible 258% in 2025.
Wait, 258%?
Yeah, massive growth. That segment is driven entirely by international sovereign demand, and it now makes up 20% of their total revenue.
Wow. Okay, let me jump in here, because that mix shift, it reminds me a lot of a classic technology pivot.
How so?
Well, think about your legacy tech companies from like a decade ago. The ones that used to sell physical hardware, servers, routers, things like that.
Right, the old box sellers.
Exactly. It's a low-margin, highly commoditized business where you just make these one-off sales. And the market typically values those hardware companies at a very, very low multiple.
Because the revenue isn't sticky?
Right. But then, a few of those companies successfully pivot. They start selling software as a service, a SaaS platform.
Yep, the golden ticket.
Right. Suddenly, they have recurring high-margin revenue. Right. And during that transition period, their overall revenue often looks kind of flat or even down because they're abandoning the old hardware model.
Right, they're shedding the bad revenue.
Exactly.
Yeah.
But the quality of that revenue is radically improving.
Yeah.
So is that essentially what we are seeing here, with BlackSky transitioning into Mission Solutions?
The sauce analogy is honestly a really solid framework, though we do have to remember the physical constraints of the space industry make it a little bit more complex.
Sure, obviously. Space is hard.
Right. But conceptually, you are spot on. BlackSky is shifting their value proposition away from just being a vendor that sells raw satellite imagery.
Which is pretty much a commodity now, right?
Exactly. It's a race to the bottom commodity. And they are moving toward becoming an intelligence infrastructure platform. They are selling the insights derived from the images, not just the pixels themselves.
I see.
But as you know from studying those legacy tech pivots you mentioned, that transition phase is famously messy.
Incredibly messy, which actually leads me to something that I'm really struggling to wrap my head around right now.
What's that?
The profitability timeline. Because despite this supposedly beautiful software-like pivot when you look at the raw numbers, their GAAP net losses actually widened to $70.3 million in 2025.
Yeah, that's a big number.
Right. So they are bleeding $70 million on paper. How on earth do we reconcile a widening massive loss with, a bullish transition narrative?
It's a great question. And you have to separate the accounting reality from the operational reality.
Okay, walk me through that.
When you look at a GAAP net loss, generally accepted accounting principles, that number includes a massive amount of non-cash charges. And the biggest culprit here is depreciation.
Because of the satellites.
Exactly. When you are a company building physical assets in space, you have to write down the value of those satellites over time on your balance sheet, even if they are still up there functioning perfectly.
Right, so it looks like you're losing money, but you aren't actually writing a check for that depreciation.
Precisely. So GAAP makes the picture look pretty bloody. But if you look at their operational cash flow metrics, specifically adjusted EBITDA, which strips out all those non-cash charges, they just crossed a critical milestone.
Which is?
BlackSky has now posted 2 consecutive years of positive adjusted EBITDA. And in Q4 2025, that metric officially turned positive.
Okay, so if we just ignore the accounting depreciation of the satellites they already paid for, the core day-to-day operations of the business are actually funding themselves right now.
That's exactly the takeaway. And the definitive signal that this transition is really sticking comes from management's 2026 guidance.
What are they projecting?
They are projecting revenue between $120 million and $145 million. But more importantly, they expect adjusted EBITDA to aggressively expand to somewhere between $6 million and $18 million.
Oh, wow. So that's a real operational profit.
Right. That is what a structural transition looks like in real time. It signals the exact moment a company crosses the desert, moving from a speculative, cash-burning growth story into a sustainable enterprise.
So the 400% run we are seeing, that is just Wall Street rapidly pricing in that 2026 profitability.
Exactly. Wall Street is looking forward, not backward.
Okay, I see the vision for where the margins are heading. But let's pump the brakes just for a second and do a reality check on their liquidity.
Fair enough.
Because if I'm managing my own portfolio, the balance sheet has some flashing red lights. Let's talk about their debt.
Yeah, the debt load is significant.
It's huge. They have $208.7 million in total debt, and that's sitting against just $43.5 million in cash.
Right.
That gives them a debt-to-equity ratio of 2.20, which is steep. Furthermore, their free cash flow yield right now is negative 6.1%.
Also true.
So my question is this aggressive growth strategy going to burn a hole right through their runway before they ever even reach that promised land of 2026 profitability?
I mean, it's the most important risk factor to evaluate, hands down. If you just look at that negative free cash flow yield in a vacuum, it looks really alarming.
Very alarming.
But we have to understand why cash is leaving the building. Their capital expenditure right now is massive. It is eating up 43.7% of their total revenue.
Wow, almost half their revenue going straight to CapEx.
Right, but this isn't operational burn where they are just, paying the electric bill and keeping the lights on. This is a highly cyclical, temporary capital spend.
What are they spending it on?
They are right in the thick of a generational hardware upgrade. They're building out and launching their Gen 3 satellite constellation.
Oh, right. So it's not like a leaky bucket. They're intentionally pouring this cash into building out the infrastructure that will generate tomorrow's revenue.
Exactly. And regarding the runway to actually survive this build-out, you need to look at their current ratio, which stands at a very healthy 3.48.
Okay, and just for anyone unfamiliar, a current ratio basically compares a company's short-term assets to its short-term liabilities.
Yeah, right. Anything over 1 basically means you can pay your bills over the next year. So sitting at 3.48 means they have significant breathing room.
Okay, so they aren't going bankrupt tomorrow.
Definitely not. Furthermore, management has been very transparent that they have over $225 million in total liquidity available through various facilities.
Okay. So that liquidity is the bridge.
Exactly. It provides the necessary runway to get through this capital-intensive Gen 3 deployment phase. Once those satellites are fully operational and the capex normalizes, that negative free cash flow yield is mathematically positioned to inflect positively.
That makes a lot of sense. So they are basically keeping their payout ratio at zero and just reinvesting every single dollar back into the business to build a massive competitive moat.
You got it.
But that really begs the question, what exactly is this heavy CapEx actually buying them? Like if Gen 3 is the key of this whole thesis, how does it actually change the game for them?
Well, it gives them a vertically integrated proprietary hardware advantage that legacy competitors simply cannot touch when it comes to unit economics.
In what way?
So the new Gen 3 satellites deliver 35-centimeter electro-optical resolution. Now that is incredibly sharp imagery from orbit, but the real breakthrough is the cost structure. They are achieving this 35-centimeter capability at roughly 1/10 the cost of what legacy competitors spend on their older 25-centimeter class satellites.
Wait, hold on. 1/10 the cost.
1/10.
Just to make sure we're grasping this, they are essentially putting an entire constellation of high-resolution satellites into orbit for the price that an old-school defense contractor might spend on just a single satellite launch.
Exactly. It fundamentally changes the math of orbital intelligence, and it protects their margins.
That is insane. How do they even do that?
Well, they locked in this cost advantage by basically controlling their own destiny. In 2024, they acquired a company called Leo Stella, which is now BlackSky Satellite Systems.
Ah, so they brought manufacturing entirely in-house.
Right. They aren't relying on third-party aerospace vendors who can, hike prices or suffer supply chain delays. They own the assembly line.
Okay, so that protects the hardware side of the business.
Yeah.
But here's where it gets really interesting to me. The software side of the moat.
The Spectre AI platform.
Right, Spectre AI. Because to put this in perspective for you listening, imagine a defense agency that needs to monitor a foreign naval port.
Okay, pretty common use case.
Right. Well, the old legacy way of doing this is like buying raw security camera footage. You get the image, but then you have to pay a room full of highly trained analysts to sit in the dark, scrub through the footage, compare it to yesterday's footage, and look for, like, submarine movements.
It's incredibly slow, it's manual, and it's very expensive.
Exactly. So what Spectre AI does is acts like a tireless digital sentry. Customers can directly task the satellite themselves, and the AI automatically detects the changes and sends analytics back in minutes.
That speed is the differentiator. I mean, they aren't delivering a picture of a port, they are delivering an alert that a submarine has moved.
Wow.
It's a real-time decision advantage. And when you think about the switching costs involved, once a sovereign defense agency builds their daily intelligence briefings around an automated feed that delivers answers in minutes, they are never going to go back to buying raw images and scrubbing them manually.
No, of course not. Why would you go backwards?
Right. That is exactly why that mission solutions revenue is so incredibly sticky.
And if their tech is truly light years ahead and literally replacing rooms full of analysts, you'd think Wall Street should be fighting to get a piece of this.
And they are.
Are we seeing that institutional panic buying yet? Because let's look at the market momentum. The technical setup here is screaming.
Yeah, the chart is looking wild.
The stock just broke out and reclaimed a major prior resistance level around $32.02. And it's doing it with explosive volume. We're seeing 4.1 million shares traded, which is roughly 2.44 times the 20-day average.
Volume is the ultimate lie detector in the stock market.
Explain that.
Well, when you see a breakout to a new high on nearly 2.5 times average volume, it signals authentic accumulation. Institutions are stepping in.
The big money.
Right. We are seeing institutional ownership currently sitting at 27.15%. And if you look at the recent 13F filings, which is basically Wall Street's quarterly report card where big funds have to legally disclose their positions, we are seeing new stakes from groups like Quarry LP and Strive Financial.
Okay, so real funds are buying in.
Yes. We are also seeing what are called whale alerts firing off in the industrial sector, indicating heavy block trading.
Wait, hold up. Let me stop you right there. Because I always thought heavy block trading could just mean a massive institution is dumping their shares off market.
That can be true, yes.
So how do we know this block trading actually represents accumulation and not just a mass exit?
It's a totally fair question. But you have to read the block trades in the context of the price action.
Okay.
If massive block trades were hitting the tape and the stock was failing to break resistance, or if it was breaking down, you'd assume distribution, funds offloading.
Right.
But when you have heavy block trading combined with a violent 400% upward price channel and a breakout above resistance, the mechanics dictate that buyers are aggressively absorbing whatever liquidity is available.
I see. So it's a regime change in the stock's sentiment.
Exactly.
But that actually brings up a glaring disconnect, though. If the sentiment has shifted so aggressively, why are the analysts so far behind?
Yeah, it's pretty funny.
I mean, the stock is trading in the mid-30s right now, yet the consensus analyst price target is sitting down at $27.40.
Right.
You have Jefferies with a target of $23. Canaccord recently pegged it at $26. Now, on the flip side, H.C. Wainwright is out there swinging for the fences with a $42 target.
Which is quite the spread.
Exactly.
Yeah.
Why is there a $19 gap between these professional analysts, and why are most of them trailing the actual stock price so badly?
It really just comes down to what assumptions they are plugging into their models. Analysts are inherently conservative, and they often get trapped looking in the rearview mirror during major inflection points.
So they are slow to adapt.
Very slow. Firms like Jefferies might still be modeling BlackSky primarily as a capital-intensive hardware business based on trailing metrics.
I see.
Meanwhile, Wainwright's $42 target suggests they are forward pricing the sauce-like margins that the Spectra AI platform is going to generate once the Gen 3 constellation is fully deployed.
That makes a lot of sense.
But to fully understand why the stock is outrunning the analyst right now, we have to look at the macro context. BlackSky currently has a beta of 2.25.
Meaning for every 1% the broader market moves, BlackSky tends to move 2.25% in the same direction. It's a high-octane amplifier.
Precisely. And right now, the broader space sector is experiencing unbelievable macro tailwinds. You have the momentum generated by the Artemis II mission. But more importantly, Wall Street is currently holding its breath in anticipation of a potential massive IPO for SpaceX, which, by the way, is rumored to carry a valuation around $1.75 trillion.
Trillion, wow. So it's basically a space halo effect.
Exactly.
But how does a private company like SpaceX, potentially going public, lift a completely different business model like BlackSky?
Because if a $1.75 trillion behemoth enters the public markets, every major portfolio manager on Wall Street is suddenly going to realize they're totally underweight in space infrastructure.
And they will scramble for exposure.
Right. And BlackSky, with its proprietary data and expanding moat, becomes a standout proxy.
I get it.
Furthermore, that kind of sector euphoria breeds M&A rumors. We've recently seen unconfirmed chatter sparked by talks between Amazon and Globalstar.
Oh, right, the acquisition angle.
Yeah, when larger defense primes or tech giants decide they want to vertically integrate space capabilities, a company like BlackSky, with its high switching costs and sticky government contracts, looked incredibly attractive as an acquisition target.
Okay, so you have this really potent mix of high beta, sector euphoria, and potential M&A sympathy.
It's a powerful cocktail.
It is. But high momentum also means incredibly high stakes. If I'm looking at this, I want to know where the landmines are.
Absolutely. You have to know the risks.
So let's explore the catalyst calendar for the next few months and map out exactly what could derail this thesis. What is the bear case here? Because looking at their revenue structure, their customer concentration is honestly terrifying.
Yeah, it's not great.
I mean, 4 customers represent 89% of their total revenue. That is a massive structural vulnerability.
It is, frankly, the single biggest risk to the long-term thesis.
And we've seen this bite them before. A while back, they face an EOCL contract reduction. For anyone listening, EOCL stands for Electro-Optical Commercial Layer, which is basically the U.S. intelligence community's program for buying commercial satellite data.
Right.
When that contract was reduced, it created a $10 million sudden headwind for BlackSky. So what happens if one of these 4 massive customers decides to tighten their belt?
It would hurt a lot.
Or what if that SpaceX IPO gets delayed by a year and the market suddenly decides that space stocks are totally overpriced? Given that 2.25 beta, couldn't a shift in macro sentiment drag BlackSky right back down to the single digits?
Look, those are very real threats. A delay in the broader space sector narrative could absolutely cause a painful multiple compression. High beta works in both directions.
Exactly.
However, let's look at how management is actively mitigating that customer concentration risk. Remember that 258% growth in the mission solutions segment?
International demand, right?
That growth is vital because it is actively diversifying their revenue base globally. They are aggressively securing multiple international sovereign contracts, meaning that 89% concentration among 4 customers is slowly being diluted quarter by quarter.
So they are outgrowing the concentration.
Exactly. And regarding the sector valuation risk, yes, a sentiment shift hurts. But unlike a speculative consumer space company banking on future consumer broadband adoption, BlackSky's revenue is tethered to concrete, already allocated defense budgets. Sovereign intelligence contracts are incredibly sticky. That creates a fundamental floor for the business that purely speculative space plays just don't enjoy.
Right. It's the difference between hoping consumers buy a new gadget versus, tapping into the U.S. defense budget.
Exactly.
So with those risks in mind, what are the near-term catalysts that will prove if this turnaround is actually real?
The main event is their Q1 2026 earnings call, which is scheduled for May 7, 2026. This is the ultimate prove-it moment.
What are we looking for there?
Investors are going to be scrutinizing the numbers for any upside to that $120 to $145 million revenue guidance, and they will want concrete updates on the Gen 3 margin expansion.
Makes sense. Anything else?
We also have the Space Symposium 2026 happening, where BlackSky is actually presenting alongside heavyweights like Palantir.
Oh, wow. Good company to keep.
Yeah, this is the prime networking ground for defense contractors. And we already have validation that they're winning in that arena because they recently secured a multi-year, sole source, $99 million contract from the Air Force Research Laboratory, the AFRL.
And a sole source contract is massive, right?
Huge.
Because that means the government didn't even put it out for a competitive bidding process. They basically determined BlackSky is the only company capable of fulfilling the requirements for these advanced optical payloads.
Exactly.
That is incredible validation of the moat.
It's the ultimate stamp of approval for their AI-enabled architecture. And there is one more macro catalyst flying a bit under the radar, a pending FCC vote to modernize satellite spectrum sharing rules.
Yeah, with that too.
If the FCC updates these regulations, it could theoretically unlock up to 7-fold more capacity for space-based broadband.
7-fold.
Right. That would act as a massive operational tailwind, vastly improving BlackSky's data transmission speeds and capabilities from orbit back down to Earth.
Okay, so when we synthesize all of this, the messy but promising transition, the massive hardware cost advantage, the institutional accumulation, and the terrifying but improving customer concentration, what is the final verdict here?
When you weigh the accelerating fundamentals and the expanding intelligence moat against those concentration risks, the bullish score comes out to a strong 7 out of 10.
7 out of 10.
Yeah. The core thesis is intact. BlackSky is successfully completing one of the hardest maneuvers in business. They are transitioning from a commoditized vendor of raw imagery into a high-margin, AI-enabled intelligence platform.
And the numbers back it up.
Right. The 258% growth in mission solutions proves the demand is real. With the AFRL sole source contract validating their tech and the Gen 3 satellites coming online precisely as the broader space sector sentiment hits a fever pitch, they are sitting at a very powerful fundamental inflection point.
So for the listener who is mapping out an actionable horizon, how do they play this?
You're really looking at two distinct timeframes here. In the short term, the volatility provides an opportunity for a swing trade heading into that critical May 7 earnings call.
Okay.
But the true wealth-building strategy here is holding a core position for a multi-year re-rating.
How long are we talking?
As that Gen 3 constellation finishes deployment by the end of 2026 and the heavy capital expenditure finally drops off, their free cash flow should theoretically explode.
Right, because the CapEx bucket stops draining.
Exactly. That is the moment that will force those trailing Wall Street analysts to capitulate and aggressively revise their price targets higher.
It's all about having the patience to watch that heavy infrastructure spend translate into massive software margins. And I think that leaves me with one final thought to ponder.
Yeah.
Because we talked heavily today about how Spectra AI acts as this digital sentry, analyzing satellite imagery in minutes without human intervention.
Yeah.
As these proprietary AI platforms get faster and the satellite resolution gets sharper, it really makes you wonder, how soon are we approaching a reality where global geopolitical dominance isn't determined by traditional military hardware rolling on the ground, but is instead determined entirely by silent software algorithms quietly running in orbit?
It's a wild thought.
It's a fascinating paradigm shift to watch unfold. Thanks for joining us, and we'll catch you on the next one.